Now the topic before us is understanding high powered money and central bank connection. First is high powered money. High powered money is also known as monetary base or base money. It serves as the foundation for the entire money supply in an economy. Now the meaning of high powered money. It is a term which is used in economics. It refers to the total amount of physical currency, that is banknotes and coins, which are in circulation within an economy, and the commercial bank's reserves held with the central bank. That is, high powered money consists of two components: physical currency in circulation within an economy, and the second part is commercial bank's reserves held at the central bank. So we have discussed the two main components: currency in circulation and the reserves held at the central bank. So high powered money is equal to C plus R. C represents currency in circulation, R represents reserves at the central bank. Here we are to note that currency in circulation means notes and coins held by the public outside of banks. Here reserves are typically divided into two categories. First is required reserves, which are held to meet regulatory requirements. The central bank of the country decides that a particular portion of the deposits have to be kept as reserves. These are required reserves. And the second is excess reserves, which are held voluntarily by the commercial banks. So R is equal to required reserves plus excess reserves. So high powered money is equal to currency in circulation plus required reserves plus excess reserves. So now the question is, how does the central bank influence high powered money? The central bank can influence the amount of high powered money through three primary tools. We will discuss the same one by one. First is open market operations. When the central bank does buying and selling of government securities in the open market, it is known as open market operations. When the central bank purchases the government securities, in return it makes the payments, it injects new reserves into the banking system, because when the central bank buys securities, it has to make the payment, and when it makes the payments, new reserves come into the banking system. The payment comes into the banking system and it increases the supply of high powered money. On the other hand, when the central bank sells the government securities, the money flows from the commercial banks to the central bank. So it absorbs the reserves from the banking system, reducing the supply of high powered money. Next is discount rate. Discount rate means the interest rate at which the central bank lends money to commercial banks. Sometimes commercial banks approach the central bank for funds when they require the same. Central bank charges interest rate from the commercial banks, which is known as discount rate. By adjusting the discount rate, the central bank can influence the demand for reserves. When the discount rate is low, the commercial banks will be tempted to borrow more from the central bank, and when the commercial banks will borrow more, it will increase the supply of high powered money. On the other hand, if the discount rate is high, the commercial banks are more likely to hold on to their reserves and reducing the supply of high powered money. That is, the commercial banks will not approach the central bank for more funds, and they will hold on their reserves, and ultimately it will reduce the supply of high powered money. Next is reserve requirements. When we deposit some money in the banks, the banks do not keep all the money with themselves. Ultimately, the banks have to make the payment to their staff, or the for the payment of building of rents, or the payment of other infrastructure, or for the upgradation of their facilities. So naturally, the banks have been established for the earning some profit from their operations. So the banks do not keep all their deposits with themselves. They only keep some portion of the deposits as reserves, as declared by the central bank. The central bank, in other words, we can say that the central bank of the country dictates that a certain portion of the deposits have to be kept as reserves, and these reserves can be used by these commercial banks for making the payments to the depositors, or some portion has to be deposited with the central bank so that the commercial banks can approach the central bank in case they want the funds. So the reserve requirements are the minimum amount of reserves that commercial banks are required to hold against their deposits. The reserve requirement may be, say, 10% of the deposits, or 5%. It may differ from country to country. By adjusting the reserve requirements, the central bank can influence the amount of money that commercial banks can lend. To be very simply, we can say that if suppose $1,000 is deposited in a bank, and suppose the reserve ratio is 10%, so the bank can lend $900 after keeping 10%, that is $100 will be kept as reserves and $900 will be given as loans. And again, by way of fractional reserve banking, the bank will again, the said amount of 900 will get deposited into the bank, and again the bank will keep 10% as reserves and will again give 810 dollars on loan, and this process goes on, though it is not an indefinite process. However, the initial deposit of $1,000 results into a big creation of money. So if this 10% reserve ratio is increased, say, to 20%, what will happen? So the banks will be in a position to only lend $800 because the reserve requirement has been increased from 10 to 20%. In that case, the banks will be in a position to lend only $800. So when the reserve requirement is high, commercial banks have less money to lend, reducing the potential for inflation. On the other hand, if the reserve requirements are low, commercial banks have more money to lend, increasing the potential for inflation, because more money will come into supply, and the more money will chase the same goods, and it will result into inflation. By carefully managing the supply of high powered money, that is, the central banks sees whether the supply of high powered money should be increased or decreased so that it can achieve its monetary policy objectives. The central bank of the country has its own objectives. It wants to keep stability of prices of the goods and services in the market. The central bank also wants to promote economic growth. It also has the objective that there should be maximum employment. So, keeping in view various objectives, the central bank devises its monetary policy and accordingly it manages the supply of high powered monetary by way of using various monetary tools. Next is, can changes in high powered money impact inflation? Yes, changes in the high powered money can influence inflation. When the central bank increases the supply of high powered money, when the supply of is increased of when the supply of money increases in the market, what happens? More money will chase the same goods and it will lead to inflation, because when the money will chase the same goods and services, the prices of the goods and services will increase. Thanks for watching. If you like our courses, please spare some time to give a star rating to our course.